Even the most promising real estate deals can fall apart when market conditions change, and initial underwriting assumptions that are included in real estate pro forma don't always end up materializing in practice. And because of this, commercial real estate investors will often run what's referred to as a stress test or sensitivity analysis on their deals to understand how investment returns might change if market conditions shift. So in this video, we'll walk through exactly how investors typically go about this process, which metrics they tend to look at most closely, and the assumptions that are most important to include within this analysis. So the way investors typically go about creating a sensitivity analysis is by using what's referred to in Excel as a data table. And a data table allows a user to see how changes to one or two different assumptions can affect certain outputs in a model without having to change these one at a time. This ends up creating a matrix of returns based on a variety of different market conditions and ultimately creates a set of best case, base case, and worst case return projections all in one place. And when it comes to the types of return projections that are usually included within this analysis, there are two main figures that commercial real estate investors tend to focus on most, and these are the equity multiple and the internal rate of return. These are the two metrics that investors in this industry use most often when advertising deals or entire funds to investors, so understanding how different market conditions can affect these metrics is really important when evaluating an investment. Now, to build a sensitivity analysis in Excel, there are a few main steps required to make this happen, with the first being creating the table itself that's going to be used to run this. And in a two-variable data table, which is what most investors will use to analyze the impacts of changes to multiple different assumptions at the same time, this process involves adding the assumptions you want to use in the top row and the leftmost column of the table you create, with the output you want to calculate in the top left-hand corner. And from there, once you have all of this information in place, you can then use Excel's data table feature by clicking on the data tab, clicking on the what if analysis button, and then clicking on the data table selection to bring up the data table window. And when the data table window opens up, you'll be asked to add a row input cell and a column input cell, with the row input cell being the input in the model that drives the assumption in the top row of your data table, and the column input cell being the input in the model that drives the assumption in the leftmost column of the data table you're building. Now, once you've added these cell references into this window, you can then click OK and either save the file or click on the Formulas tab and then the Calculate Now button to recalculate the workbook. And from there, Excel will automatically create your outputs at the intersection of each assumption. Now, a sensitivity analysis is only as helpful as the inputs that are included, so the assumptions that you choose to add here end up being really important. And the first and often the most common metric used by investors within a sensitivity analysis is the assumed exit cap rate on a deal, which is used to calculate the sale price at the end of your projected hold period. Especially for shorter term business plans, the exit cap rate can have a huge impact on projected returns, especially the IRR, since in these cases, the sale value will make up almost all of the projected cash flows. An aggressive exit cap rate assumption can make a bad deal look okay and an okay deal look like a home run, so sensitizing returns based on multiple different potential exit cap rate values can be a huge help to investors that are looking to manage risk. Most investors will analyze different exit cap rate scenarios in increments of about 25 to 50 basis points, meaning that if a base case assumption is to exit at a 6% cap rate, that investor might analyze returns based on a 5%, 5.5%, 6%, 6.5%, and 7% exit cap rate within their sensitivity analysis. And by doing this makes sure an investor can analyze the expected returns of an investment in a wide variety of different potential market conditions if interest rates were to rise, investor interest were to fall, or if any other major shifts were to happen that would impact valuations. Now, the second major variable that investors will typically analyze is the rent growth assumption in a model, which is also one of the biggest drivers of returns on a real estate deal. And unlike the exit cap rate, rent growth assumptions will impact both the projected sale value of the property and the cash flow from operations the property is expected to generate, which makes these really impactful to investment performance over the long term. And similar to the exit cap rate, investors will typically add a range here that they think is realistic in a variety of different market conditions. So if the base case rent growth assumption is 3% per year on the deal, an investor might use 1%, 2%, 3%, 4%, and 5% in a sensitivity analysis to see how each of these scenarios would ultimately play out. Now, the last metric I want to mention here that's very commonly added within a sensitivity analysis is directly related to the exit cap rate we talked about earlier, and this is the projected hold period of the asset. How quickly capital is returned to investors can have a major impact on the IRR of a deal, since cash flows received earlier in the investment period are weighted more heavily than cash flows received later in the investment period, all else being equal. This is also often used to identify a potential sale year when the IRR would peak in the analysis, specifically by sponsors who are raising capital and looking to maximize returns they can show on paper when marketing the deal to potential investors. In a lot of cases, especially on value add or opportunistic deals where the NOI is projected to increase really quickly after the property is acquired, the IRR tends to max out at some point between about 3 and 7 years after the initial acquisition. Running this kind of analysis can also be a really helpful way to see what returns would look like if the investor had to sell later than projected due to difficult market conditions, or what the potential upside of a deal might be if rents were to grow more quickly than expected and the property was sold early. Now, in most cases, investors will advertise either a 3, 5, 7, or 10-year projected hold period. So these are typically the intervals that are used within a sensitivity analysis, but these can be longer or shorter depending on the business plan. Ultimately, stress testing your deals is all about understanding what your most important return metrics would look like in a variety of different scenarios, all in one place. And this is a great way to understand what your best case, base case, and worst case returns might look like if you end up being wrong on some of your key assumptions. And if you want to learn more about how a sensitivity analysis is typically built into a real estate financial model, or how to build out more advanced data tables that can show things like the impact on 2 different returns within the same cell, or analyze changes to 3 or more variables within the same table, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on the different types of analyses that investment firms will typically run when underwriting a deal, make sure to hit the like button and let me know. And let me know in the comments if you'd want to see a more detailed step-by-step walkthrough on anything we talked about within this video. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.